Earnings, Middle East tensions, and the outlook for inflation. Welcome to Market Insight. I'm Paul Barber. Treasury yields recovered from a short reprieve caused when news broke of a tit-for-tat missile attack on Iran. A spike in oil was also short-lived. While Wall Street benchmarks on Friday were swayed by earnings, Netflix's disappointing outlook dragging on the Nasdaq. American Express, though, lifted the Dow. To digest this week's market volatility is Jeff Schulze, Managing Director and Head of Economic and Market Strategy at ClearBridge Investments. Great to see you, Jeff. Thanks for joining us. First of all, how mindful are you about what's happening between Iran and Israel today? Are you looking more towards safe haven assets?
Well, the knee-jerk reaction overnight was to go into safe havens like treasuries, and you saw a spike of oil markets, but that's largely reversed. And I think a key reason here is that you've had a pretty large geopolitical premium that's been built into those areas over the last couple of weeks. So again, this has already been priced, but I think maybe more importantly, when you look at the two attacks, it really does suggest that each side is really just trying to establish them as a threat and deter further attacks, and neither side really wants to go all in. Iran called the operation a failure, which suggests that there's not going to be a meaningful retaliation. And I think maybe more importantly, because there wasn't a lot of damage from either attack and no fatalities, this is early signs that this is more symbolic in nature, and it really does open the door for de-escalation as we look forward. So I think that's why you're seeing a relatively muted reaction from Wall Street today. And it's not to say that this can't escalate further, but signs do point to it moderating out on the horizon.
Yeah, well, let's hope so. And the other and bigger concern driving sentiment is, of course, the Fed. How would you position yourself ahead of next week's PCE reading? And what would you need to move the dial on your Fed expectations?
Well, now that we have CPI and PPI, you can really leg into what the PCE reading is going to be next week. It does suggest, based on what we got earlier this month, that PCE on a core basis is going to be running at an annualized 3%. So obviously a little bit less than what we saw with CPI, but this is going to keep the Fed relatively hawkish, especially considering that you have a really strong economic backdrop in the U.S. and a very resilient labor market. So with the markets already taking out a full rate cut from 2024's expectations, I don't really see it being market moving, as the markets have already priced what the outcome is likely going to be.
Okay, Jeff, so also next week we have major names in tech reporting, Meta and Alphabet, as well as Tesla. What are your expectations?
Well, next week is going to be the biggest week of earnings delivery for the S&P 500, and I really think it's going to set the tone for the rest of the earnings season, right? And I think if you look at the Magnificent Seven stocks that are reporting next week, it's a little bit of a Goldilocks situation when it comes to prior Q1 earnings releases. For example, the cold porridge would be Tesla. Tesla has fallen significantly in 7 out of the last 8 Q1 earnings reaction days going back to 2016. Now, Tesla's already down about 11% over the last month, so this may set up a positive surprise, but Q1 has historically traded bad for that particular stock. Microsoft is more of a lukewarm porridge, if you will. They've beaten on both the top and bottom estimates in each of the last Q1 earnings reports going back to 2018. And they've traded higher the day following in 10 out of the last 12 earnings reports. And Microsoft is down about 5% over the last month. And then lastly, Meta would be the hot porridge, if you will. Meta is traded higher by at least 5% on each of the last 6 Q1 earnings reports. So there's been a lot of pessimism that's been baked into a couple of these mega cap tech stocks. And I think that sets up a potential surprise to the upside when we get earnings.
And staying with Meta and Alphabet, are their current valuations justified?
We think they are justified. These are really good companies with strong growth prospects and rock solid balance sheets. And, these are going to be beneficiaries as we continue to move forward from an AI perspective. So although their valuations look high, I think they're going to be able to grow into those earnings, and I think they're going to be able to surprise to the upside, but we're going to obviously have to get to next week to see whether or not that's the case.
Jeff, always great to get your thoughts. Thanks so much for joining us. That's Jeff Schulze from ClearBridge Investments. And that's your Market Insights. There are more videos on Reuters.com.